All right, it looked like the participants number stopped going up. So we're going to begin here. Good afternoon, everyone. My name is Brent Fuchs, and I'm a partner with Heritage Financial Consultants. Welcome to Heritage's 2021 Speaker Series. We're happy for those that are able to join us and participate. We've designed this speaker series to provide you with clarity regarding some of today's biggest economic and financial questions to help you manage your financial future. An industry expert will present each week on topics we've been hearing are top of mind: current economic activity, the markets, and trust and estate laws. Before I introduce today's speaker, I would like to remind everyone of the upcoming speaker series presentation on May 11th. Tom Sessa, partner at Sessa and Dorsey, will provide an update on estate and trust laws in his presentation. Depending on the time we have left at the end of this presentation, we will open up for Q&A. Mr. Dillon will try to address as many questions as possible today. Please raise your hand through the Zoom platform, and we will unmute and call on you at the end of the presentation. Please also feel free to reach out to your Heritage advisor to help you answer any additional questions. Now it is my distinct pleasure to introduce today's speaker, Chris Dillon. Chris is an investment specialist in the multi-asset division at T. Rowe Price. He provides broad insight across the various views that T. Rowe Price has across the equity and fixed income divisions. Mr. Dillon is also responsible for communicating how the firm's multi-asset team is allocating across asset classes from longer and shorter term perspectives. Mr. Dillon is Vice President of T. Rowe Price Group, Inc. and T. Rowe Price Associates, Inc. Mr. Dillon, the stage is yours, and thank you.
Brent, thank you. Everyone that's joined, thanks very much. Enjoy these conversations a great deal. Interesting time to be investing. Little weakness in technology stocks today. We'll talk about that. But look, as investors here in the US, we've had just an enormous privilege to be invested in the S&P 500 since let's call it March of 2009. Fast forward to today, investors have earned about 19% annualized return. So each year on average, about 19% per year. This runs very counter to what somebody like Dr. Jeremy Siegel writes a book, great read, Stocks for the Long Run, History of Stock Markets. What Dr. Siegel has told us is to expect about 6 to 8% in terms of returns from the stock market over a full investment cycle. As I said, since March of 2009, it's been extraordinary. It's been 19% returns per annum. And if you happen to be a growth investor during that time period, it's been even more remarkable than that. And I hope you don't mind, I just jotted some notes down just to enrich this conversation today. I won't be reading notes. It's going to be more like this visual. Look forward to the questions as well. But, you know, as I said, about 19% returns per year for the past decade. But if you were invested in, like say, the Russell 1000 growth, that's an index that captures higher growth companies. And I'll define growth stocks in just a minute versus value stocks. But during that same time period, you were earning north of that, around 21, 22% per year, as opposed to the 18, 19% from the market itself. So not so distinguished. But if you were even more specific and invested in the FANG stocks, or what we're calling today FAAMG, Facebook, Amazon, Apple, Google, Microsoft, you know, those stocks, extraordinary growth that they've delivered during the past decade. But a basket of stocks like that have delivered 33% returns per year for the past decade. And against that backdrop, if we could move to slide number 7 in this investment deck that we're sharing to guide our conversation today. This just gives you a sense for growth stocks, those that are rapidly growing faster than the average growth of the S&P 500, going back to the 07-08 timeframe. And here's this remarkable, time period for being invested as a stock investor in the market during the past decade. Look, you did great in value, but you did extraordinarily well in growth. This is a technology story. And where we've landed is now you have 5 stocks that make up around 35% of the Russell 1000 growth. The good thing about this story, and I think for many long-term investors, I'm talking about this remarkable run in the stock market. I travel, represent T. Rowe Price, meet with a lot of clients, often get questions around, well, Chris, isn't this a repeat of 1999 into 2000? And for those of you that have long-term investors, you remember the market turned horribly wrong, 99, 2000, tech wreck is what they called it. Well, what's different about today versus back then is the chart, the right-hand side of this chart. We're focused on total returns on the left-hand side of this chart, but on the right-hand side of this chart is free cash flow growth. Big technology stocks, ones that I'm talking about, Facebook, Amazon, Netflix, Google, generate an enormous amount of cash flow, a very strong underpinning in terms of what's behind these stocks, propelling the market powerfully forward for the past decade. This is very different than 1999, 2000. Is there some weakness in the technology in the growth space right now? There is. But is there fundamentals underneath of the hood? Very different than 99, 2000? Absolutely. So before going any further with this conversation, I think it's good to maybe back up just a moment to talk about just what a definition of a growth stock versus a value stock. And like you, I work at T. Rowe Price. Not like you. I work at T. Rowe Price, but like you, sometimes I need to look something up to refresh just the definition on different parts of the investment environment that we're investing in. So I went to Investopedia this morning, looking up the definition for a value stock: trades at a price below its fundamentals, such as dividends or earnings. Those are examples of fundamentals. But let's define this, quantify, what a value stock is in terms of what to expect from earnings growth, what to expect from like a valuation, like a price to earnings. So the market, on average, earnings growth, going back past the past decade and beyond, on average, you can expect about 5 to 7% earnings growth is what you can expect from the market. So value stocks tend to deliver earnings growth, revenue growth along that trajectory of the market. But what can you expect from growth stocks relative to 5 to 7% is what we get from the market from earnings growth over time on average? Well, why don't we look at something like Amazon? And Amazon, I was just taking these notes this morning, has been on average growing revenues by about 30%, and right now is delivering earnings per share. After it pays all of its business expenses, Amazon is starting to generate a really handsome profit. Aggressive investing back in itself during the past 20 years has allowed Amazon to just become a behemoth. But in terms of earnings per share growth, 12% as opposed to that 5 to 7% from the market. Now, we're having this conversation today, and we're having it via Zoom. So in my line of work, I'm normally traveling half my time. Well, in a pandemic environment, not traveling at all. I'm having an engagement with you today on Zoom. Well, a lot of people are having engagement on Zoom. So an aggressive growth or an ultra growth stock would be something like Zoom. So let's just put that into a conversation. Again, market 5 to 7% earnings growth over time. And what would a price to earnings on just an average stock in the S&P 500? Why don't we just call it 17 times earnings? But I talked about Amazon, and where Amazon trades is more like north of 50 times, 60 times, 70 times earnings. But aggressive growth supports and catches up the earnings back to that fundamental story. But let me get to Zoom. And Zoom, in terms of revenue growth over the past, let's call it 24 months. Why don't we call it 300% revenue growth? Why don't we call it net profit growth of around 2,000%? Aggressive growth. It's been great to be a growth investor. It was great to be a growth investor for the past decade. It was good to be a growth investor last year, but value stocks, cheaper stocks, what they need to succeed, and normally there's sectors that are very much tied into value versus sectors that are tied into growth. Growth is very much technology, and I gave you 2 examples. I gave you Amazon and I gave you Zoom, two very good examples of growth, above market, much above market growth. But value stocks tend to be lower growers. And so the sectors that come into play that have to be evaluated if you're going to be invested in value would be financial stocks like a Wells Fargo, or energy stocks like a Halliburton and oil services. They make up energy stocks, financial stocks, and industrial stocks, maybe like a Weyerhaeuser or a Caterpillar, are examples of value stocks. So for the past decade, investors, if you just did growth and forgot about value, congratulations, you did great as an investor for the past decade. But we have arrived in a very unique moment in the market. So I'm going to move now to slide number 15. So besides this great run by the market, 19% returns per year for the past decade, going all the way back to March 2009, last year the pandemic hit, and it's a tragedy of life, tragedy in many different ways. But the market, the S&P 500, since March 23rd of 2020 until now, is actually up 88%. S&P 500 earnings last year dropped about 30%, and yet the market is up about 88%. And the picture I'm showing you right here is there's two things. So one is this navy blue line moving left to right. That's just the overall price of the S&P 500, which is up 88% since March 23rd. That pale blue line moving left to right that just drops off in that shaded area, that's the minus 30% earnings from last year. So I guess I'll ask a hypothetical question. If we were all meeting live, I would be asking a question and looking for a response. But how is it possible? So it's a hypothetical question. I have an answer to it. How is it possible that the market is up 88% when earnings dropped off a cliff and you see that price just moving just powerfully northward? Well, there's two answers to the question. So now if we can move to please slide 12. Let me explain this picture, because this is a big part of the answer for how the market is up 88% since March 23rd last year. So what we've aggregated in these bar charts that are moving from left to right is, I guess we'll call it stimulus response. Government officials, central bank, Jerome Powell at the Federal Reserve, head of the ECB, China, you name it. Global policymakers got together last year, understood the pandemic for the great global tragedy that it was, and decided they did not want a repeat of the Great Depression. I mean, because when the global economy just suddenly stops and there's a cessation of economic activity, that's the type of environment that the United States experienced and the world experienced in the 1930s. There was just not enough money supply moving around, and the Great Depression was the Great Depression. And I'm going to stop there. Somebody came here today for a history lesson. But to address the threat of that type of scenario off of COVID-19, Federal Reserve cut interest rates to zero. Federal Reserve has a balance sheet where it can even give more boost to the stock market, give more boost to the economy. Last year, let's call it early 2020, that balance sheet was about $4 trillion. Today, as I speak with you, that balance sheet is about $8 trillion. Federal Reserve led the way to combat the pandemic, but everybody else joined into this effort to stave off a global depression. So look at that mountain of stimulus over on the right-hand side as you go pale blue, and you just see the scale of stimulus. So let me just quantify what that mountain on the right-hand side is. It's about $28 trillion. The value of the world's stock market in aggregate is about $50 trillion. And it's taken, a century to build up to that level. In a matter of, let's call it 9 to 12 months, global policymakers threw $28 trillion into the global financial system. This is one big reason why the market's up 88%. In terms of, earnings dropped 30%, market's up 88%. $28 trillion of stimulus has washed into the global financial system, pushing up the stock market and risk assets in general in a pretty powerful way. So what's the good thing about this? The good thing about it is that it happened, and that we have a great stock market, and the lights have been left on in the US economy. Very unique recession here with COVID-19 against the backdrop of support from the unemployment perspective, just stimulus support that's gone out from the United States government. And in atypical fashion in this recession, this COVID-19 related recession, normally incomes plummet and normally personal savings plummet in that type of a scenario in historic recessions. This time, consumers are sitting with about $1.6 trillion of savings on their personal balance sheets in aggregate. Personal incomes actually rose during the pandemic. A very unique environment. I guess the good thing about all this is that it happened and the market's up 88% and the lights have been left on in the US economy. But we're getting ready to economically reopen. And when I say we're getting ready to economically reopen, I don't know how everybody's doing with their vaccine. I had COVID back in November. It was absolutely awful. Feel very lucky to have survived it. Got my first shot last week, my second shot May 18th. We're estimating 200 million adults in the United States will be vaccinated by July 1st. Sports venues this fall are going to be played in front of packed audiences. It's going to be a very different environment as the U.S. economy reopens. And U.S. growth, which is averaged for the past 10 years, about 2%, we're estimating U.S. growth this year about 6 to 8% growth, probably followed by another 5% growth in 2022. The good news is that this is happening and we're reopening and we're getting past COVID-19. The bad news for risk assets is there's going to be some parts of the market that are going to be very receptive to reopening, and it's actually value stocks. And there's actually going to be some weakness for technology stocks and growth stocks as we do this transition from where we were pre-pandemic, which was very growth friendly. You get into the pandemic and technology and growth still working really well. Back half of last year, value stocks were starting to wake up to this reality of higher growth in the US, reopening. Think hotels, think airports, think transportation, think all of that stuff. That stuff drives value stocks, not so much growth stocks. And if we could please move to slide 18. So the other phenomenon here to think about, there was two reasons why the market was up 88% last year when S&P 500 earnings dropped 30%. One I just showed you was a mountain of policy stimulus thrown into the global financial system. Let's thank our policymakers for staving off a depression, the likes of which would have probably been worse than the 1930s if we hadn't got that. So that's one part of the answer. We just talked about that. The good thing is we got it, but at some point it begins to fade off, and that represents a challenge for risk assets, for growth assets. That's one part of the story for the market being up 88%. The other part of the story is earnings of technology and growth actually held up remarkably well during the pandemic. I gave the example of Zoom and how its revenues, net revenues, like net profit, increased by 2,000% because we're doing engagements like this. Those earnings didn't fall off a cliff. They actually accelerated. Amazon earnings accelerated. Google, you name it, technology very well served during the pandemic. So this navy blue line moving left to right, look at it, just muscles right through the pandemic. But now let's think about a global industrial. How about Caterpillar that makes heavy equipment, sells that equipment all over the world? Do people want to buy heavy equipment when the global economy completely shuts down? Absolutely not. Does the earnings profile of big industrial stocks, General Electric, Caterpillar, Ingersoll Rand, those kind of names, did their profits drop like a rock last year? They absolutely did. So two things, market up 88%, a lot of stimulus. We talked about that. The other is earnings resilience of technology. But here's the thing about this resilience of earnings technology. If Zoom revenues net income was up 2,000%, is it likely to repeat that if we're reopening? I think the market's asking big questions around. It makes for a tough comp, is what we say in the industry. Tough comparable from a revenue standpoint. But value stocks, the bar is set extremely low. And if the bar is set really low from an expectation standpoint, and all of a sudden the US economy is going to go 6 to 8%, then cheaper value stocks have a platform here to perform pretty well. And here's just the expectation for recovery of industrial stocks. There's one more slide to just power in this point of economic recovery, and the market's going to behave differently. There's going to be different beneficiaries when the market opens up versus what technology has done for the past decade and for last year. So if we could please back up one slide. That slide right there. This slide is dated June of 2020 on purpose. So remember I was saying that the market earnings dropped about 30% last year. Well, the second quarter of last year was particularly bad. And I bring you to this page to just highlight, I mentioned growth stocks, technology stocks, actually were pretty resilient last year with earnings. But so where the big earnings drop off came from was really in value type of stocks. So this pie chart over on the left-hand side, you'll see the energy sector, you'll see bank loan loss provisioning, meaning banks, financial institutions, took a big part. They made up a big part of that big earnings drop off last year. So that impacted those parts of the market, pounded those parts of the market until later last year when all of a sudden the market started realizing, hey, there's going to be these wonderful vaccines and we're eventually going to reopen. But where we're reopening and where earnings recovery is going to come from, it's going to come from those that got hurt the worst last year. And it's energy, it's airlines, it's Marriott. And think about, say you're Jamie Dimon and you're running JP Morgan Bank and it's March of 2020. Pandemic has hit. And now you're trying to make a decision of, you have an option. Do I take loan loss provisions if it's going to be really bad in 2020 in an uncertain pandemic? If you're Jamie Dimon, I think the answer to that question is easy. You take loan loss provisions to put them aside, hit your earnings, save for a rainy day, put yourself in a position to play in the fourth quarter of the game, if you will. Just take a break now, wait for later. Loan loss provisions just absolutely crushed financial earnings last year. Well, guess what? Now we're getting to the other side of COVID-19. Now we're reopening. Now people are getting vaccinated. And the pandemic wasn't nearly as bad because of what policymakers did. Why am I mentioning all this? I'm mentioning this earnings recovery. Think energy sector, think banks, because those loan loss provisions, they didn't get used. They come back into earnings, meaning financial stocks are going to do really well. Travel stocks are going to do well. Marriott's going to do well. Energy sector is going to do well. And industrials are going to do well as well. If we could please move forward. And one more. And another. So let's stay here. So one way of evaluating stocks is to look at the net profits, think of the net profits as cash flows, and then think about how much money am I getting in a money market account? And let's discount those cash flows to come to a price for a stock. That's what T. Rowe Price does. It's how we value stocks. It's discounted cash flow analysis. Well, if you have this idea that right now the Fed funds rate, what the Jerome Powell and the Fed, and they set interest rates at a certain level. Right now it's zero. And if you're discounting cash flows at zero, it just is absolute rocket fuel for stock prices. And for T. Rowe Price, when we're evaluating growth stocks, the growth trajectory, the exercise, looks very far into the future. It looks 3, 5, 7, 10 years. So we're looking at modeled cash flows divided by a very generous low interest rate, and that gets to a very attractive. This is why growth stocks have done remarkably well for the past decade. But they're what we call long duration assets, meaning if it's aggressive growth and say Amazon trades at 60, 70, 100 times revenues, it's earnings that have to catch up to support that valuation. So you have to look into the future. You have to have imagination about all that. Why am I beating this point into the ground? Beating this point into the ground in that if we're going to grow 6 to 8% in the United States this year, and we're going to go 5% next year, and Jerome Powell at the Fed is saying he's not going to do anything with interest rates until 2023. But if we're going to start growing aggressive and we're going to have recovery, we may be getting higher interest rates sooner than people think. And if that's the case, technology and growth does not like that environment so much. Value stocks are better positioned for that environment. And that's the moment that we're in right now from an investing standpoint. Look, we're not calling for market collapse in technology companies. T. Rowe Price is big owners of Amazon, Facebook, Netflix, Google, you name it. These companies are very well positioned for the future, but there's going to be this moment here for the market. And we're anticipating 12 to 18 months where there's going to be dollar cost averaging buying opportunities. It's a very important time to be working with your financial professional, navigating through what's a pretty tricky time in the market, because you're going to see weakness in technology stocks. And it doesn't mean that anything's broken at Amazon. It doesn't mean that anything's broken at Microsoft. It's just 2021 is a year where growth is gonna get beat by value. And I think the point of working with your financial advisor is making sure that you have some value stocks in your portfolio to help offset this ride, which is going to get a little bumpy the back half of this year. If we could please move forward. And forward. And now I'm going to get to the punchline and we can get to some questions. I'm looking at time and I'm sure there's questions. And if we could hit slide 24, please. And the point on FAAMG, Facebook, Amazon, Microsoft, Google, those big names, and then other technology names is, look, we're living in a period of rapid disruption. I think of where I came from, and I'll go ahead and date myself. I was a credit analyst for Wilmington Trust Bank, back in the 90s, working my way up from a career standpoint. And there was 3 of us sharing one PC. I think if that was the 90s, and I think of where we are today, internet, cloud, healthcare disruption, media, there's disruption as far as the eye can see. Technology stocks still very well positioned for the future. It's just a difficult environment at the current moment. But I guess to bring this whole thing in for a landing is slide 28. 2020 was all about the pandemic. Tragedy last year. But let's thank policymakers for throwing the kitchen sink at the pandemic. And that kitchen sink was $28 trillion of stimulus, which has allowed the market to be up 88% since March 23rd last year. Technology stocks very well positioned for the first half of last year, thinking of Zoom, thinking about all things connective. I think of myself buying a Peloton bike, working out at home as opposed to going to the gym. All of those things were part of that story of 2020. 2021 is all about the vaccines. It's all about economic reopening. We're of the mind World Series 2021 going to get played in front of a packed house. If that's the case, people getting back to the dentist, and a stock like NVST, if you look at the trajectory of that stock over the past 6 months, it's anticipating reopening, people getting back to personal hygiene and getting back to the dentist. Look at a stock like Live Nation, sponsors concert events where people congregate. The stock has been moving, the anticipation of moving to the other side of COVID-19. 2021 is all about the vaccines and reopening, and value stocks with what we call cyclicality should be part of a portfolio to position through this truly unique investment environment. There's opportunity here, but working with your financial professional at a truly complex time to be investing, it makes a ton of sense from T. Rowe Price's perspective. And I think the last thing that I'll share would be, I sit at T. Rowe Price Multi-Asset. If you're not familiar, we're a $1.5 trillion global investment management firm. I sit in multi-asset. I get to see what the T. Rowe Price stock professionals are doing. I get to see what T. Rowe Price fixed income professionals are doing. I get to see the street come in and give their ideas on what's happening. I get to see all those inputs. I pack it into a snowball. I have conversations like this. I think I have the best job at T. Rowe Price. So thanks everybody for showing up. But page 31, just to leave you with, this is the world as we see it. And 1.5 trillion is our global assets under management. 420 billion of that is multi-asset, where I sit at T. Rowe Price, where again, I get to see all of what's happening at T. Rowe Price. And we essentially, provide representative portfolios. Let's call it 60% global equities, 40% global fixed income. And then we divide up the world, and sorry for the tiny font here, across the different markets that we can invest in. Yeah, we've done a long-term market study. Neutral is right down the middle. And then you'll see what we're favoring. And generally speaking, we have tilted towards value in this environment. And we're being cautious in fixed income because we are thinking there's going to be higher inflation than what's priced into the market. I'm sure hopefully that comes up in the Q&A. But being cautious in fixed income, tilted towards value, cyclicality, and then having some outside the U.S. stocks to round out a diversified portfolio. Again, in a truly unique time to be invested. I know when I'm out of breath, it's time for me to stop talking. I hope there are some questions. So I'm going to pause there.
All right, Chris, appreciate all your insight. We're going to give it a couple seconds here to raise some hands uh, and get some questions here. Let me see. The first question goes to Nasser Ali. I think Marcus will turn it over so we can pull Nasser in for his question.
Great, thank you. Can you hear me?
Yes.
Hi, great. Chris, thanks a lot for your comments. Great presentation and really insightful. I was thinking about a couple different things here. One of the things was prior to COVID, we had the e-commerce that was really picking up steam as time was going on, and really was causing some economic and some kind of business paradigm shifts, if you will. But with COVID, it really kind of put the e-commerce spin, if you will, into overdrive and really super accelerated the influences of e-commerce. So upon reflection, has there been a time in the past that you can think of that where there's been a similar transition, where there's been not so much from a technology perspective, because obviously technology is future and forward looking and we're not there yet, but is there another time in the past where there was a significant change or a paradigm shift where investing took a different way of looking at investments on a going forward basis?
Love the question. And yes, I think, we're reflecting on what was happening last year. You framed it well. E-commerce was disruptive before COVID-19 hit. And then COVID-19 hit, and in some ways, developments and impact of e-commerce that we expected to take 5 to 7 years to play out happened actually in 1 year. Which is the nature of your question. Where else have we seen anything like this? And I'll be candid, I guess two things, and they're not perfect fits relative to your question. I think one is I think of the roaring 1920s, and you think of the disruptive technology of that time, radio, what propelled certain individuals to power in the 1930s and the medium that they used to do that, was when you read the stories of the time, it feels like that type of paradigm with this new technology reaching mass audience. I'm thinking of, I was a history major in school, but I get this history feed on my Twitter, and there's a picture of Charlie Chaplin addressing this just throng of people in New York City. And would that have been possible unless you had that technological shift that just moved in just a big, remarkable way? So I guess to answer your question, early 1920s would be part of that story. And I think of F. Scott Fitzgerald and The Great Gatsby to just be just a great piece of fiction to capture that truly unique time period. I also then think of like Great Depression, World War II, and I think of my dad fought in World War II, and I had a chance to talk to him about that. He was in the Navy, but a lot of guys that served in World War II weren't all that excited to get home because what they remembered was the Great Depression, and they were wondering what they were going to do next. And I think troops get back, and then you get the building of Levittown in the suburbs, I-95, just transformation of the United States off of, World War II broke it up, but I guess it's that. And then I think about 1999, 2000, when everybody gave up on value investing, and it was, pets.com, and it was, a price to earnings. Like right now, the market, people are nervous that the market right now is 22 times. It's 22 times, so price to earnings, it's 22 times 2022 earnings. And that is rich, but 1999, 2000, it was more like 50, 70, like 80 or 90, maybe 100 times, depending on what sector you were looking at. So I think, the paradigm shift then was, Y2K came and went. And then all of a sudden people started looking at the money's not getting spent for mainframe computers and Y2K. And then all of a sudden value investing has a great 4 to 5 year run. So I don't have a clean answer to your question. Your question is spot on, but we just experienced what we expected to take 7 years to play out. It just happened in 1 year. So now you look at the market today, it's a little choppy in tech land. I think the market is coming around to the reality that the comps in the back half of this year for tech relative to that phenomenon that your question captures, I think that's where you're going to see some squishiness on the growth tech side. So Nasser, I didn't completely answer your question cleanly, but love the question. I'm sorry I didn't have a better answer.
No problem. Thank you.
All right, we've got another question for you, Chris, coming from Helen Greenblatt. Hopefully we can get her unmuted so she can answer her question.
Thank you. I'm curious, does T. Rowe Price have a fund that captures the ideas in your asset allocation committee chart here?
So yes, and it's not pitching, but you asked the question. I appreciate that opportunity. So you just tossed me a softball, and I'm going to go ahead and just push it out the right field. So I appreciate that. So yes, it's called the T. Rowe Price Global Allocation Fund. When you see me looking away from the screen, I'm just looking up the ticker, but captures the representative portfolio that you see here. It is this global allocation fund, captures it to a T. Let me just get the ticker off of my Bloomberg terminal. Bear with me. It is R as in Reggie, P as in Paul, G as in Gus, AX. That's the T. Rowe Price Global Allocation Fund. Very much captures this picture in front of you here. I appreciate the question, Helen. Thank you.
And I have another one, if I may, real quick, and that is,
yep.
Can you clarify why it is that when the treasury yields go up, the tech industry goes down, the tech values go down?
So what I was trying to explain, and I was long-winded about it. So different parts of the market, some parts of equities, and I had to learn this year. It became important this year. In the past, it just didn't matter. This year, it matters because we're of the mind that right now, a 10-year treasury yield that's hovering around 1.6%. We think inflation in the second, third quarter of this year is going to be up, and there's multiple reasons for it. And we can get to the.
Most people agree with you.
So I'm not going to beat that point into the ground. But if we agree on that, so we're of the mind that a 10-year treasury yield is on its way to 2%, probably going more than that. So if that's the case, what we learned when we ended last year, a 10-year treasury yield was yielding about 90 basis points, less than 1%. And now we're about 1.6%. But during this move of the yield going from 90 basis points to where we are now, 1.6, and it'll be on its way to 2, this impacts the growth side and the technology side more than it does the value side. So one is why is it friendly to value? And then I'm going to answer your question on the growth because that was your question. But think about financial stocks. Think about how banks make money. Do banks make more money when interest rates are higher? Yes. And if Fed funds is 0 and a 10-year treasury yield is 2%, what do banks do? They collect deposits and right now not paying out a lot. And if they can lend that money out, that's how banks make their money. So sorry, this is just helping me, calibrate my own thinking about why financials do good here with higher interest rates. So that's financials. Energy does good with this, industrial stocks, all of that, but they're shorter duration assets. Our analysts, because they are cyclical, they're tied into the economy. The forecasts around companies like that, we only go maybe 3 to 5 years out, and it's just a much shorter time frame for evaluating the companies because they're much more tied into the fortunes of the economy. So that's value. Let's put that over here. Let's get to your question. And I talked about it. I said higher interest rates not so friendly for tech and for the growth side. So when we're trying to evaluate companies that have aggressive growth, and we're thinking of them in terms of, so say there's a stock, let's call it Amazon, or let's call it something like Zoom, and I wrote this down to prepare for this call, but the price to earnings on Zoom right now is 131 times. The price to earnings for UPS, that's being a big beneficiary of COVID-19 and delivering packages, is 22 times. The market is about 22 times. Zoom 131 times. Amazon is actually 62 times. So let's focus on Zoom and 131 times. And we're at T. Rowe Price, and we need to capture these high growth companies, but we have to be creative. We have to be imaginative with evaluating the price. So when we look at a Zoom, and this is where it gets to Nasser's question of we just experienced like 7 years of development in 1 year. So here we are looking at, is Zoom going to be 131 times? Should we pay that price for that stock? We had to ask ourselves that question last fall. And if we missed it, like say June or July last year, we missed out on a great opportunity. But to be creative like that, we have to take those projections on a company like that, and we have to take them out 5, 7, 10 years. And along that time period, we're anticipating a certain amount of revenue, and then we're discounting the cash flows based on today's interest rates or interest rates like where they were at the end of last year. When interest rates change, and the idea is interest rates are going up, it changes the discount rate. And if we have models that are 3, 5, 10 years out, when you change that discount rate, which is determined by interest rates, if those interest rates are higher, it's like kryptonite for the valuations of those stocks. Let me stop for those types of stocks. Let me pause there, and I hope I answered your question.
Yes, thank you. That was insightful.
Thanks for the question.
Thank you, Chris. We got another one from Nasser Ali. Nasser?
Thank you very much, Brent. Chris, you also mentioned, I think you mentioned that you implied that you were the T. Rowe Price and your team and so on, maybe taking maybe a different look at things. And maybe because there are some different winners and losers through the COVID period, and certainly kind of goes back to that initial paradigm shift kind of question. But can you peel back a couple layers of the onion and give us some insight as to what are some of the things you thought of differently? How did you look at stocks or the investment markets or whatever a little bit differently than you had before because of the pandemic?
So I think for us, Sebastian Page is the gentleman that heads our asset allocation committee, or just heads up multi-assets. That's 421 billion over 1.5 trillion. Great individual to work for. You'll see him on Bloomberg TV from time to time, CNBC. But one thing, if you catch him on the press, one thing he always comes back to is, and this is something we were talking about this time last year, is that stocks are normally rising about 70% of the time. So generally speaking, we're overweight stocks. So I guess, to answer your question, Nasser, about, where we need to be a little unique, is if you'll notice at the top of this page, and sorry for the tiny font, but you'll see it's dated, end of February 2021. Where we are right now is we've actually modestly gone underweight stocks. Now, look, I'm not saying we're outselling everything, like we're not. So when I'm saying we're modestly underweight stocks, if our neutral is 60% global equities, I'd say right now we're about 58% global equities, but we're normally overweight stocks. So why would we be like underweight stocks here a little bit? We've been taking away from growth tech. If it's higher interest rates, that's tough for those stocks. The other thing would be regulatory environment for big tech. I'm sure we all noticed that Jeff Bezos kind of stepped away from his seat as CEO, billionaire. Maybe he wants to enjoy life. Maybe he doesn't want to be in Washington, D.C. testifying with greater regulation of big U.S. tech. It's a headwind for tech, higher interest rates, headwind for tech. And here's the other thing. I mentioned Jeremy Siegel's book, Stocks for the Long Run, 6 to 8%. We just had a decade of 19% annualized returns in the S&P 500, capped off with 88% since March 23rd last year. And I guess here's the thing that we're thinking about, and markets are always thinking ahead, and we need to be thinking ahead because we're managing 421 billion in assets. So, what are a couple of things here that give us room for pause where we've just nudged a little bit underweight stocks, and we hardly ever do that. So it's two things. One was that $28 trillion of stimulus. The good thing was that it happened. The bad thing is at some point it starts to fade, meaning there's a hangover, modest hangover waiting. Probably towards the end of this year, early next year, there's going to be some stimulus hangover, and economic recovery won't fill that entire gap. That's just a huge number, and there's going to be some fade. But economic recovery helps push against that. But that's why you want value stocks to benefit from that. But the other thing would be, what are we reading in the paper right now? This is not a political statement that I make, but if the government has been very aggressive with policy, and this needed to happen in a COVID-19 environment. But my point is, taxes are going to be going up. Now, corporate tax rate goes from 21% I think we're not. I think we're going to say the bargaining that's happening probably goes to 25, 26%. Highest tax rate goes back up to the 39%. Maybe it comes in a little bit, some bargaining, but higher taxes and stimulus fade, those are headwinds for the market where we've decided to back up a little bit. So I guess, Nasser, to answer your question, we're normally always overweight stocks, and right now we just went a little bit underweight, and we're very much leaning on value to help get us through, to answer your question.
All right, Chris, as we see if anybody else has any questions, I got one more I'll throw at you. So with much of the dislocation in today's market, as you talked about, between value and growth, do you think passive index strategies will have the clout of the past, or do you think a paradigm shift will give active management the upper hand?
So, Brent, I appreciate the question, and because of where I work, I think you know how I'm going to answer the question. Yeah, we're very much for active management, but I think we're of the mind that there's about 25% of the market that's been disrupted. So let me give a couple of examples. So, one is, think about the movement to the cloud. That's a big deal. And think about like a stock like IBM that was very much tied into mainframe computers. And think about everybody that was tied into that ecosystem around mainframe computers. Well, if everything's moving to the cloud, do people need those five guys with the thick black rim glasses with duct tape around the middle holding them together to hold their mainframe together? The answer is they don't need those folks. And you look at a stock like IBM, and I think it's performing well here over the past 6-9 months, but we're thinking 3, 5, 7, 10. And IBM, I guess they did what we call a Hail Mary pass. They knew they were behind in the cloud, and they bought a company called Red Hat in the summer of 2018, and they spent too much money for it, and it hasn't made up the difference in the cloud. Why do I bring this up? IBM stock is cheap, but should we be invested in it just because it's cheap when it's disrupted? So I think for us, there's more stocks than IBM. And I'll give another example of, like, maybe on the consumer staple side or the consumer food side. So I think of Kraft mac and cheese. I was a big consumer of it when I was a college student, particularly if I had a hangover. But things have migrated, tastes have evolved, organic considerations come into play. Organic Kraft or organic mac and cheese is outselling Kraft mac and cheese. So I bring this up as Kraft Heinz, to us, is an example of a disrupted company, not reinvested in itself, in its brand, and consumer preferences kind of move around that. So I just, those are two examples of stocks that are going to be cheap, but active managers can actually look past just these extreme back and forth of COVID-19, and then get to the other side and just think, is this cheap for a reason, or is the market missing it? Active management is going to have a field day in this environment, Brent.
Thank you, Chris. And I'm pausing for maybe a couple other seconds to see if anybody else throws up their hands. All right, doesn't look like we have any more questions. Thank you, Chris. Your presentation was fantastic. Love the discussion between value and growth. Thanks again. We'd like to remind everybody, again, speaker series coming up next Tuesday, May 11th. We thank you for your time. Look forward to seeing you again next week for Mr. Sessa update on the estate and trust laws. Thank you, guys. Have a good rest of your Tuesday. Take care.
Thanks, everybody. Bye-bye.